In 1949, a man sat in a New York restaurant, reached into his jacket pocket, and realized he couldn't pay the bill. No cash, no checkbook, no way out. That moment of humiliation would create a financial system that now moves over $5 trillion every year in the United States alone. A system that changed how we shop, how we travel, how we borrow, and how we go into debt. One forgotten wallet, one bruised ego, one idea that rewired the global economy. This is the story of the most expensive dinner in financial history. Welcome back to the Financial History Channel. The Humiliation. Our story begins inside Major's Cabin Grill, according to the most popular version of the story, in February 1949. At a prime table sits Frank McNamara, president of Hamilton Credit Corporation. Sharp, connected, confident. He's hosting a business dinner. The meal goes well. The deal seems secure. Then the check arrives. He reaches into his pocket. Nothing. He checks again. Nothing. The wallet is at home, in another suit. Now imagine this is you. You're at dinner with your boss. The check comes. You pat your pockets. Your Apple Pay is dead. Your cards are at home. That feeling? That's what launched a revolution. In 1949, there was no universal credit system for everyday purchases. You paid with cash, or maybe a check, if the restaurant trusted you. This wasn't just inconvenient. It was humiliating. His wife quietly covered the bill. The evening ended, but the embarrassment didn't. We can only imagine what was said on that ride home. And sometimes, humiliation is the mother of innovation. But here's the real question. Why didn't something like the credit card already exist? And why did nearly every major bank in America think the idea was reckless, even dangerous? The idea nobody wanted on the ride home. McNamara couldn't shake the feeling. There had to be a better way. Department stores had charge accounts. Oil companies issued fuel cards, but every system was closed. What McNamara imagined was radical. A universal card, accepted at multiple establishments, backed not by cash, but by trust. He partnered with Ralph Schneider and Alfred Bloomingdale. Yes, that Bloomingdale. They called it Diners Club. Simple idea. Approved members get a card. Restaurants accept it. Diners Club pays the restaurant. At the end of the month, the member pays Diners Club. No cash exchanged at the table, just a signature. It sounds obvious today, but in 1949, bankers were skeptical. Unsecured credit? No collateral? A cardboard card backed only by reputation? Here's why that terrified them. Banks made money from secured loans, mortgages, car loans, business loans backed by assets, lending to strangers based on a signature, no house or car to seize if they don't pay. That violated every rule in the underwriting manual. And restaurants weren't thrilled either. What if Diners Club didn't reimburse them on time? What if customers refused to pay? What if fraud exploded? If enough people defaulted, the whole experiment could collapse. To traditional finance executives, this wasn't innovation. It was financial madness. Cardboard revolution. February 1950, exactly 1 year after the embarrassing dinner. Diners Club launches. The first cards weren't plastic. They were cardboard. Thin, fragile, plain. 27 restaurants agreed to accept it. 200 members signed up. It could have died right there. And in the early months, it nearly stalled. Some restaurants hesitated. A few customers paid late. By the end of 1950, 20,000 members, over 1,000 participating establishments. The idea wasn't just convenient, it was prestigious. Pulling out a Diners Club card signaled status, modernity, trustworthiness. It was membership in a financial elite, and that social signal accelerated adoption. McNamara had turned embarrassment into empire, but something bigger was happening. Banks were watching, and they were beginning to realize they had made a catastrophic miscalculation. Because what McNamara had created wasn't just convenience, it was a new profit engine. And once banks understood that, they would take the idea somewhere even more powerful. The moment everything changed, Diners Club and American Express operated as charge cards. You had to pay the full balance every month. No interest, no long-term debt. Then in 1966, Bank of America introduced something different, BankAmericard, later known as Visa, and it introduced revolving credit. Now you didn't have to pay the full balance. You could carry part of it forward. You would just pay interest. That small adjustment changed everything, because interest is where the real money lives. In the early 1960s, American household debt levels were modest. Credit was tightly controlled. By the 1980s, revolving credit had exploded. By the 2000s, the average American household carried thousands in credit card balances. Today, total U.S. credit card debt regularly exceeds $1 trillion. Minimum payments, compounding interest, APR rates often above 20%. And here's the uncomfortable truth. Minimum payments are designed to keep you in the system. The longer you revolve a balance, the more profitable you become. Studies from Harvard and MIT found that people spend 12 to 18% more when using cards versus cash. The plastic made us generous with ourselves. This wasn't just payment convenience anymore. It was behavioral finance. When no physical cash leaves your hand, the psychological pain of paying decreases. Spending becomes abstract. Friction disappears. And when friction disappears, consumption rises. Banks didn't just join the game, they engineered it. Frank forgot his wallet in 1949. By 1966, banks made sure you'd never forget theirs. So here's the deeper question. Did McNamara create financial freedom? Or did he unknowingly build the foundation for a culture of permanent debt? The cultural transformation. Credit cards did extraordinary things. They enabled national retail chains, airline loyalty systems, online commerce, e-commerce giants, instant global transactions. Without card networks, modern internet retail likely doesn't scale the way it did. They reduced crime tied to carrying cash, enabled travel, streamlined accounting. For disciplined users, credit cards became tools, building credit scores, earning rewards, providing fraud protection. For others, a trap with a 23% interest rate. Revolving credit normalized borrowing for lifestyle. It made consumption immediate and payment delayed. It shifted society from save then buy to buy now, pay later. That psychological shift may be one of the most profound economic transformations of the 20th century. And it began with a forgotten wallet. The wallet that started it all, maybe $40 inside. The system it created, over $1 trillion in revolving balances. The real bill. Frank McNamara likely never imagined the scale of what he started. He solved a personal embarrassment. He created a convenience tool. He built a profitable business. But what followed was larger than any one man. Today, billions of cards circulate globally. Trillions of dollars move through invisible digital networks. Entire industries exist because that cardboard card worked. So the next time you tap your phone, swipe a card, or click buy now, ask yourself, are you using the system, or is the system using you? Sometimes the biggest revolutions don't begin in boardrooms. They begin with embarrassment. And sometimes the most expensive bill in history is the one you forgot to pay in cash. If you enjoy deep dives into the moments that reshaped the financial world, subscribe to the Financial History channel. Because history isn't just what happened, it's what's still shaping your wallet today.